Joan C. Williams, What Works for Women at Work, for Patterns Working Women Need to Know. Do you find yourself struggling to navigate the world of stock investing, unsure of how to choose stocks that will provide the best return on investment? In his book, What Works for Women at Work, for Patterns Working Women Need to Know, Joan C. Williams provides a comprehensive guide on how to identify and use investment strategies that have a proven track record, while avoiding pitfalls often encountered by impulsive or inexperienced investors. The book delves into the world of passive and active investing, the efficiency of markets, and taps into the influence of human emotions on stock prices. With a solid foundation in research, Williams puts forth winning investing models and tips on how to follow them with discipline and consistency. Get ready to take control of your investments and grow your wealth with the wisdom imparted in this book summary.
Beating the stock market with passive investing. The stock market can be beaten with less risk by using a passive investing strategy. Traditional value measures combined with strong price appreciation yield the best results. People often inaccurately price stocks due to emotions, providing opportunities for those using simple, time-tested strategies. Passive investors rely on index funds that represent the market while active investors try to beat the market by picking stocks. However, less than half of actively managed mutual funds outpace the index. Passive investing has gained popularity due to its success, with index funds growing from $10 billion in 1980 to $250 billion in 1990. The failure of active investing. Active investing fails because human emotions cloud judgment, and investors are prone to unreliable patterns. This problem can be overcome by investing in explicit rules with reliable and objective guidelines that use steady and credible data. Small stocks and large companies that dominate their sectors perform well over time, while mid-cap and large caps lag. Market models that include microcap stocks are flawed. The key to successful investing is to stick with a strategy patiently and consistently, ignoring negative headlines. Stock performance metrics. This summary outlines the importance of various stock performance metrics and how they can inform investment strategies. Investors have long been captivated by the stock market's potential to yield high returns. The challenge lies in predicting which stocks will perform well, especially since past performances do not guarantee future success. This is where stock performance metrics come in handy. The most popular performance metrics include P/E ratios, price-to-book ratios, price-to-cash flow ratios, price-to-sales ratios, and dividend yields. The data suggests that an investment strategy based on these metrics can yield high returns with lower risk. When it comes to P/E ratios, large stocks with low ratios tend to perform best. A $10,000 investment in the 50 large stocks with the lowest P/E ratios grew to $3.8 million with an annual return of 14.1%. In contrast, stocks with high P/E ratios performed poorly, with an investment in the 50 companies with the highest ratios growing to just $558,000 over the same period. Like P/E ratios, price-to-book ratios are a reliable predictor of stock performance. Investing in the 50 stocks with the lowest price-to-book ratios yielded an impressive 15% annual return, compared to just 5.2% for all stocks. Price-to-cash flow ratios also provide valuable information about stock performance. Large stocks with low ratios are less risky and more profitable. An investment of $10,000 in these stocks grew to $4.5 million over 45 years, compared to just $335,000 for the 50 companies with the highest ratios. Price-to-sales ratios are another important metric to consider. Investing in stocks with low ratios has paid off handsomely over time, with an investment of $10,000 in these stocks growing to $8.3 million over 45 years. The same investment in stocks with high ratios yielded just $92,000. Finally, dividend yields provide an indication of a company's ability to pay dividends to investors. Large stocks with high dividend yields outperformed the market, growing from $10,000 to $2.9 million. In conclusion, an investment strategy based on these stock performance metrics can yield impressive returns with lower risk. While past performance cannot guarantee future success, the data suggests that these metrics can inform sound investment strategies. Investing strategies debunked. Don't rely on 1-year or 5-year earnings per share growth, net profit margin, return on equity, or relative price strength for investing. Investing in stocks can be daunting for many people. There are so many factors to consider that it can be difficult to know where to begin. One way to approach investing is by looking at various strategies that have been proposed over the years. Unfortunately, as this book shows, not all of these strategies are created equal. For example, one popular strategy is to invest in stocks with high earnings per share growth. However, the book's analysis shows that this strategy often underperforms. A $10,000 investment in the top 1-year earnings gainers only grew to $1.3 million over 45 years. Buying stocks with the lowest earnings growth isn't any better, as an investment in the 50 companies with lowest earnings growth turned into $1.5 million after 45 years. Similarly, investing in stocks with high net profit margins or return on equity is not always the best strategy. While these stocks can perform well, they are also riskier than other stocks, and often don't provide returns that are significantly better than the overall market. Finally, the book examines the strategy of buying stocks based on their relative price strength. While buying stocks with the highest 1-year appreciation can be profitable, the significant volatility that accompanies this measure makes this strategy difficult for most investors. Conversely, buying the 50 weakest stocks gave horrible returns of only $43,000 after 45 years. Overall, the book's analysis shows that there is no one-size-fits-all strategy for investing in stocks. Investors need to consider a variety of factors when choosing stocks, and be prepared to adapt their strategy over time as market conditions change. Maximizing returns through multi-factor modeling. By combining value and growth measures through multi-factor modeling, investors can significantly boost their returns, especially for small stocks. For example, investing in the 50 stocks with the best price growth and P/E ratios below 20 saw a return of $22.7 million over 45 years, while stocks with the highest 1-year price growth and price-to-book ratios below 1 yielded a return of $18.6 million. Additionally, by investing in the 50 stocks with the highest relative price strength and price-to-sales ratios below 1, a return of $23.3 million was achieved. This approach can not only enhance returns but also reduce risk by diversifying investments. Winning strategies for investment growth. This book offers a ranking system for identifying the most successful investment strategies. With data spanning from 1954 to 1996, the rankings are based on the growth of $10,000 across 66 different strategies. The top strategy is identified as having a price-to-sales ratio less than 1 and high relative strength, with an earning potential of $13 million. The second best strategy involves stocks with an earnings yield over 5 and high relative strength, with a potential earning of $12.6 million. Conversely, the lowest performing strategies are identified as having a high price-to-sales ratio and low relative strength, earning only $64,000 and $30,000, respectively. Successful stock investing. Learn to invest smartly in stocks by following proven strategies using historical data, maintaining consistency, diversifying and combining multiple approaches. Avoid falling prey to risky investments and emotional decisions. Are you considering investing in the stock market? The lure of hot stocks with great stories might be too strong to resist, but be cautious. According to past patterns, high P/E, price-to-sales, and price-to-book ratios associated with such stocks can be dangerous. The key to success is to invest in strategies that have been proven profitable over at least 25 years of historical data. A consistent but mediocre strategy is better than the hit-or-miss approach of most investors. Diversify your portfolio among a few growth and value strategies, and combine factors like P/E ratios and relative price strength for better performance. Don't fall prey to risky investments or emotional decisions.
Investing in stocks can bring both unparalleled returns and considerable risks, depending on the methods one employs. Joan C. Williams' book, What Works for Women at Work, for Patterns Working Women Need to Know, offers a clear, evidence-based approach to navigating the stock market. The book examines the role of human emotions in stock pricing, as well as the effectiveness of passive and active investing. By learning to prioritize strategies over impulses and making data-backed decisions, you have the opportunity to transform your investing methods and enhance your returns. With Williams' insights and proven models to guide your actions, embark on a journey to master the art and science of investing, optimizing your financial success.